Hi, James Good here with another quick on the money video update for Tuesday, August the 21st. Now, last week there was a lot of yawning on my Twitter stream. Traders complaining about the summer doldrums, a lack of volume, lack of movement. And in that week, the major averages carved out a very tight closing range, 0.35% over 7 trading days on the S&P to be precise. And that kind of low volatility is very rare, as it turns out. But don't grumble, because volatility is always cyclical, and sleepy markets today invariably mean wilder markets tomorrow. Now, there are two noteworthy features of these kind of tight ranges worth remembering as you debate whether to get involved here or stay out. Now, Jason Geppert of Sentiment Trader, he churned the numbers last week and came up with 23 prior instances going way back to 1928, where there were 7 days with this kind of tight closing range. Well, I've gone a step further and plotted them on a chart. This is the Dow, which I have continuous prices for back to the 1920s, but the essential story is the same. Let's take a look at the very first example, which occurred way back in 1940. This was the closing range, here was the breakout, and here was the retest, which is the first thing I noted about all these instances. They all retested the breakout range. Certainly if they broke upwards, they did. There was one instance of the 23 where it broke downwards and just kept on going. But since we've broken upwards, this was typical. Just a couple of days breakout and then a gradual retest, and if prices were going to go higher, they then continued from there. Here's the generational low in 1942, and here is this tight closing range in September of that year. Break up higher, retest, undercut the lows very slightly, and then carried on. And there were quite a lot of these types of examples. And another one from 1955, where again prices surged higher, sucking in a lot of investors, only to be smacked in the jaw. And a lot of stops were taken out here before the thing turned around and crawled its way back on higher. Occasionally it took a few weeks for the reversion and retest to happen, and this was in 1964 and 65. Here you had a breakdown and then a break up, which took about a month to complete, and then here in October a break up followed by a breakdown. And the same again happened the following year in 65 on the way to a notable top. Even in 1995 and 1996, these low volatility grinds upwards, prices still had to retest their breakout levels. This one broke down in 95 and this one in 96 broke up, but again retested and then carried on in the same way. And coming right up to date, you can see the same pattern in 2010. In November, you remember the QE rally of late 2010. Prices surged upwards, fell back, undercut the lows to take out some of those stops, and surged higher. Again, pretty much the same thing, a push higher over a few days, retest, carry on towards another notable top. And here's where the second factor comes in. 12 of the 23 instances going back to 1928, the first one here in 1940, were at or within 3 to 4 months of a significant top. So some of them were the beginnings of bear markets, such as this one in 1940. Others were significant corrections waiting to happen. This one in 1943, for example. Here they occurred very close to 2 peaks in 1957, one just before and one just after. This was a substantial correction in the beginning of 1960. Here was the big crash of 1962, where the signal occurred right at the top. And most recently, of course, in late 2010 in the lead up to the crash of 2011. So to sum up, expect a retest of the breakout zone from last week, hope for a strong reversal, otherwise we might have hit a major turning point.